My name is Connor O'Daly. I work in the Pengana distribution team. Delighted to be joined this morning by Peter Baughan, who's co-PM of the investment strategy, working with Harding Loevner, based over in New Jersey. So thanks for joining us, Peter. I'll hand over to him shortly. We have about a 40-minute webinar this morning, covering off what's going on in markets. It's obviously on people's minds. We've seen what's happened in the United States overnight. So it's turbulent, volatile times. So hopefully we'll have some good things to talk about as we move through the webinar. A reminder that you can ask questions. There's a questions tab at the bottom of your screen. We'll get to all those at the end. I've no doubt we'll have a lot of questions. So hopefully we've got plenty of time to discuss that. The other thing I just want to remind people about is we're discussing the Harding Loevner investment strategy. This is the same investment strategy that's implemented across the international fund and also our listed investment company, Pengana International Equities Limited. The only difference between the two of them is that we implement the Pengana negative screens over the listed investment company, and there is only one stock that's different in the two portfolios, which is quite a small weighting. So almost the exact same things that we'll be discussing today. So if we just move through to the next slide, we've been partnered with Harding Loevner on this fund and listed investment company since May 2021. Quality growth investing is something we hear a lot of these days, but this track record of the strategy dates back to 1989. So really Harding Loevner have been doing quality growth investing before it was even really a thing. It's an incredibly large institutional quality investment manager, and one of the only ways that more intermediated or retail clients can get access to the investment strategy is through the fund and the company that we have in place here in Australia. So we're incredibly privileged to be partnered with Harding Loevner. We have full integration of ESG factors in the process. And importantly, there's no star manager, which we see a lot of in Australia, one star manager running a very large fund. The process is really what drives the return. And it's been the same process for an incredibly long period of time. But individual decision-making and accountability is incredibly important to that too, right through from analysts up to the portfolio management level. And Peter will give you a flavor as to how they think about markets and how that implements itself in the strategy a little later today. One thing I want to talk about in the listed investment company, which is different to the trust, is that we pay fully franked dividends from the company, which is something we're only able to do in a company structure. And I can discuss that a little bit further if there's any questions how it all works. One of the things that we changed a couple of years back was to pay a quarterly dividend to our investors. We think that people value that regular stream of income that they get from the listed investment company. We've just declared the next dividend, which is 1.35 cents per share, ex-date on the 30th of May, and the record date of 1st of June, paid soon after that. It works out to a dividend yield of around 5%, fully franked up to 7%. It's actually a little less than that today because the share price has ticked up over the last few days, but something that we're focused on delivering for our, I suppose, more retiree clients. We're an outcomes focused distribution team. We want to make sure that we're delivering good things for our clients. And so we know that that's quite valued for that client base in the listed investment company. That's pretty much all I've got to say. It's, as I said, been a turbulent time in markets overnight. It's been a pretty tricky, I was going to say start to the year, but we're almost halfway through now. It's moving quickly. And so I'm going to hand over to Peter from here on out to discuss their approach to investing, performance and portfolio positioning going forward. And a reminder to please ask questions as we move through, and we'll get to as many of those at the end as we can. Peter, over to you.
Good morning, everybody. So I'm going to try to spend not too much time talking about Harding Loevner, the process philosophy, and leave time for questions about markets. There's pretty much chaos in the U.S. market overnight, as you saw, and we are learning rapidly and in a very rapidly changing environment how management teams are coping with what has become a very, very tricky and fast-changing environment. Let me back up for make a couple of context points, and then we can talk about what's happening now and portfolio dynamics and all that stuff. So, just as a reminder or as information, if you don't know, Harding Loevner is one of the investors out there that has been pursuing a quality growth investment philosophy. For us, what does it mean? It means we spend all of our time as research analysts identifying businesses that operate in industry structures that are very, very sound from a Michael Porter perspective. And you might be familiar with that. The 5 forces that Michael Porter, who was a Harvard Business School professor many years ago, identified. These 5 forces determine the profit margin, stability, and direction of an industry. And you're probably familiar with them: bargaining power of suppliers, bargaining power of customers, the rivalry, substitution, barriers to entry, all those things. If we identify business structures, industry structures that are healthy, we will find businesses, if we do our job right, that are more profitable and lower risk consistently. So if you look at the portfolio, what you're seeing here is a cross section. The businesses in the portfolio are demonstrably higher profitability than the market. Profit margins are higher, return on assets are higher. Return on equity is currently the same. It's typically higher. It has been and will be again. When we talk about lower risk, we talk about having lower standard deviation of returns in the business over a cycle and much greater financial strength. So when we talk about profitability, we're talking about businesses that operate in industry structures that permit good management to allow consistent profitability over the years. And we put a big focus on profitability and quality, because without quality, we can't trust duration of growth. Okay, so it's all about quality and growth duration. And so the second thing we require, of course, is faster growth. And we look at businesses that have demonstrably faster sales growth, earnings growth, and cash flow growth in the market. And you can see that in the right-hand side of the chart. The businesses have been growing meaningfully faster than the market. Now, in the last 4.5 months, that's not been a good thing. Faster growth has not been a good thing in the last 4.5 months. It's been a good thing in the last 20 years, but not the last 4.5 months. But this is what quality growth means for Harding Loevner. It means we have businesses operating in industry structures that permit well-managed businesses to be consistently high quality. And if management foresight and capital allocation is strong, we can see faster growth. We have about 450 businesses like this under research scrutiny around the world, and that's our approved list. Okay, so what are we doing all day long? We're looking for businesses like this that become mispriced anywhere in the world, and we want to add them to the portfolio. And so at a time like this, it's a weird combination, right? It's very nerve-wracking when prices are plunging all over the place, but it's the best time. It's absolutely the most opportune time for us to be finding mispriced, high-quality growth businesses that look like this, that are going to seed the ground for the future outperformance. So I just want to make a couple points on this. Let's keep going. Let's step back. Here's our long-term track record. I want to give you a sense of what to expect or what we have delivered over 30 years. But by the way, I've been at Harding Loevner 25 years. I'm in my 20th year as a co-lead PM on this strategy. So I've had a chance to experience much of this track record you're looking at. But I want to give you a sense of what is the pattern of performance. If we're investing in high-quality growth businesses, and if we're paying attention to price, what has the performance pattern been historically? It may or may not be that way going forward, but it's kind of useful to say what it has been. So this is just looking at 5-year annualized returns. By the way, we have a 5-year horizon. We are actually long-term in all of our thought process. And what it shows you is that 76% of the time, the portfolio is outperformed over these 30 plus years of our history. It breaks down somewhat into types of markets. When markets are declining, we've outperformed 88% of the time. Moderate markets of 0 to 10% return, 75% of the time. And in strong markets, 69% of the time. So it just gives you an idea of what the pattern of rolling returns looks like. If you look at some of the dots below the line, I'll show you another slide in a minute. A lot of that was in the 03-04 period when there was a very strong value rally, which we're now experiencing again. And but it's typically our underperformance is bunched into periods of time when there's a so-called value rally, as opposed to quality growth businesses that typically do better than value businesses, but their stock prices don't always do better. Okay, let's keep going. I'm not going to spend a lot of time on this. I just want to give you the punchline. We sort every single company in the world into one of 4 quadrants based on the fundamental analysis that we use. And this just happens to be healthcare sector. But it's kind of hard to see, but there's 4 quadrants, okay? There's quality growth, there's quality on the horizontal, and growth on the vertical. And businesses up and to the right are the highest quality, highest growth businesses in the world, and this happens to be sorted by healthcare. Then on the lower right, we have the highest quality, lower growth businesses. Upper left is the most dangerous quadrant. That's the highest growth, lowest quality. Remember what I said? We need duration, but we don't get duration of growth unless there's quality. And so we take high quality so seriously. Businesses that are plot in the upper left are rapidly growing, but low quality. So it's danger zone. Down to the left, low quality, low growth. Harding Loevner traffics in, okay, let me target rich environment to the upper right and the right. And what we do is we plot every single business in the world from the bottom up using our own analysis that we've created over the years. And then we systematically identify the businesses that meet a deep dive criteria. But I just want to point out, so when we have 55 businesses in China, it's not because they're in China. It's because they have, from the bottom up, punched quality growth fundamentals competitively with the highest quality growth businesses elsewhere in the world, and they happen to be in China, or the same for Japan or France. It's all bottom up. Okay, let's keep going. ESG. I don't know how much you want to talk about ESG, but for us, it's integrated. What does it mean? It means that analysts, we have industry analysts and then company analysts follow from that. The same analyst that does the industry analysis and the company analysis does the ESG. There is no separate ESG team or ESG overlay. It's integral to the risk analysis and the business analysis. And of course, I'm sure you've heard this before. Long duration growth companies can't afford to have ESG issues. Certainly, the environment, there's very few environmental issues in high return on capital, long duration growth companies. Social has become much less frequent as managements have woken up to all the complexities of social issues. And then governance has been a longstanding issue, emphasis here, where we typically weed out governance issues up front. But ESG for us is integrated right into the analysis by the covering analyst of a company and industry. It's not a separate add-on. Let's keep going. Okay, risk management. We look at risk in a number of ways, a lot of factor analysis, a lot of forecast volatility and so forth. But what I'm showing you here is what we call our common man standard. Common sense standard. We've used this for 3 decades. We say, look, let's just have some general geographic diversity that requires us to have a spread. We can have anywhere between, I think it's the number of investments can be up to 75, so 35 to 75 holdings upper left. But we require those to have a minimal spread around the world. We have to have a certain number of sectors, maximum in any one sector, minimum number of countries and markets. So it can only be 5% of the portfolio in one security. The United States, it has to be between 25 and 65. In France, you can see it all the way down there. Emerging markets can go up to 25%. This is just common sense. It says, let's have the exposures minimally spread around the world, and let's keep individual stock exposure capped at 5%. And this has served us well over the years. Let's keep going. So performance, it's been a rough start. I'm going to show you the 20 years. We've had a rough 4.5 months, rougher than I'd like. When I looked at the analysis, about 40% of our underperformance year to date is style headwind, which means that systematically our quality growth stocks are underperforming lower quality, lower growth stocks. We also have had expensive looking stocks because we've emphasized growth, and that was not the right way to come into the year. In my 20 years, I don't think I've ever seen such a fast, complex shift in macroeconomic fundamentals. You may have read this morning about Target in the US or Walmart yesterday, these stocks falling 25% in Target's case, or Walmart 20% over 2 days. It's fascinating to me to read the management commentary. It's so similar to what Amazon management said several weeks ago. In fact, if you want to do something interesting, go check out the Amazon earnings transcript from fourth quarter, which was in early February, and then look at the one from 1Q22 that was in April. Total reversal of almost everything they were thinking. In early Feb, Amazon was literally saying, we see the sun coming out. That was their quote. We think that the supply chain difficulties are behind us. We think that the wage complexity is behind us. We're feeling good about where we are. We've been buying back stock, which Amazon doesn't do very often. Fast forward 3 months, total reversal. Really surprised by the magnitude and dimension of change, rapid growth in costs, freight problems, supply chain problems, renewing with the zero COVID lockdown in China and complexities from the war. And they completely messed up their labor management, as Walmart did, overhired, ended up with excess capacity and so forth. But I was pretty fascinated in an unfortunate way by the number of management teams that we follow that did a 180-degree U-turn on how they were seeing their business results and fundamentals in the 3 months between February and April, March, May of this year. The impact of the zero COVID in China and the war has really been more significant than many management teams expected, and certainly more than I did. I actually thought, and this is one of the reasons why I returned support this year, I really didn't think we were going to see this structurally high accelerating cost supply chain energy issue complemented by, you see behaviors of consumers shifting what they're buying. Really didn't expect to see that persisting and to the degree it has. Because if you go back and rewind the tape, we all know what happened. We were all there. We saw the government shut down supply. We saw them ramp demand. And it seemed to me to be this one-time thing, right? You're going to shut down supply, you're going to ramp demand, you're going to get the pig going through the python as you have inflation spike, but it would normalize. If there's one thing the world knows how to do, it's manage logistics, it's manage global supply chains. But no, I think the problem has been, obviously, that China has decided to shut down the economy in a very draconian way. And then, of course, the war and the unexpected complications. And so it's brought forward a lot of complexity and a lot of chaotic change in business results that has led to quality growth stocks, especially fast growth ones, having a very significant underperformance. That's the bad news. Now, the good news is this is like a kid in a candy store. If you want to be a stock picker right now, this is the time. I mean, it's bad. I'm not trying to minimize it. It's bad. Our results are worse than I'd like. I think about 40% are style selection, our style headwind, and I think 60% are poor stocks. We overestimated growth in the short term in any number of names. So I'd say 40% style, 60% stock selection. On the other hand, we've been through it before. We've seen it before. The details of this one are different. But it's in times like this when I am most excited, and my colleagues are most excited, because we thrive on finding mispriced, high-quality growth stock. And the way I'm looking at this period is this is the seed sowing period for future harvest. So let's look at this at the chart now. It's a 20-year history. It happens to be the same history of basically I've been co-managing this portfolio. And we began 20 years ago in an underperformance period because we had an extremely strong style headwind. You may remember, I don't know if you remember or you read about the 03, really 03, 04, but high quality investing, which everybody's loved until recently, right, underperformed dramatically. Growth underperformed dramatically. Value, expensive looking stocks underperformed dramatically. And we had all of this underperformance. What did we do during that period? We didn't change. We just stuck with the highest quality growth names. We just added to them. And we said, you know what, we like them at this price, we like them even more, 25% down. So we just gradually kept focused on the same type of high quality growth business that got cheaper and cheaper. And then we were able to come roaring back with outperformance. And then you can see over the years, we've had these periods of outperformance and underperformance. If you were to look at this 20-year period, and the reason I'm saying this is we're going back into an aggressive value environment. I don't know for how long, and that's a big question. But our 1Q22 numbers, which you can see on the far right, were actually the second worst in the last 20 years. I don't like saying that, but it's factual. However, what we wanted to point out is, why do we do quality growth? Why does anybody do quality growth? It's because of compounding. If we have quality, and if we have durable, long duration growth with management teams with foresight and change management, capital allocation skills, we get bailed out by compounding. I know it sounds simple, it's easy to forget, but the reason we like, or the reason people like quality growth investing is it bails you out over time if you stick with it. And that's the message from this chart. If you looked at this chart and you bought in the beginning when it was underperformance and you held it to the end, which is also underperformance, the first and second worst periods starting and ending this chart so far, you still would have made 120 basis points net excess annual return. Okay, it's a 9.39% US dollar return against an 8.19% market. I happen to have those numbers, but that's 120 pips net if you held from the beginning to the end, despite the fact it was worse in the beginning. It was a bad period in the beginning, bad period in the end. I think we have one more chart just to give you a little sense. I won't spend time on this unless there's questions, but this is a really cool, helpful chart. This is looking at the same 20-year period, okay? And what we're saying is if you go along the top of that chart, from 01 to 06 to 11 to 16 to 21, you could sell it. You want to know what would my experience have been as an investor? You can go along the top of that chart and exit at any one of those quarters, and you can say, okay, when did I invest? And you go down you go down the diagonal line, and you pick a spot, and you just intersect the boxes. You say, okay, I invested in the third quarter of 2003, and I held it in the third quarter of 06. You probably lost about 5.5% a year. I can't see the numbers on this Zoom, but that's about. But if you held it through now, you're up probably 140 pips annual excess net return. But that's buying at the worst possible time in the last 20 years. And you can go through it. What we've done here is make this available. You can say, well, what happens if I bought it this period or sold it that period? You can see exactly what your experience would have been. There's a punchline from this. The punchline is it's probably better to buy in the red than the green. Okay, if we had perfect foresight or hindsight, the time to buy into a quality growth strategy, anybody's, not just ours, is when it's underperforming. Like the time we want to be doubling up on a quality growth name is not when it's been having this big run. It's when it's had a hiccup. It's when it's been underperforming. Well, the same thing works for quality growth managers. Now, if we all had perfect foresight, if I knew what this chart was going to look like for the next 10 years, I would say to you, why don't you wait to invest or double up in the red period? And then you've got a better chance of outperforming, just like we have a better chance of outperforming when we buy high quality growth businesses that are underperforming and cheaper, all else equal. But we don't know how it's going to end. So of course, what we do is we layer in and we hold it for compounding. And that's the message from this chart. Any questions on that? We'll come back. Let's keep going. Okay, what's on our mind? I'm not going to spend a lot of time on this. I'm kind of curious on what's on your mind. And we can talk about that. But what's on our mind is probably similar in some ways to what's on your mind. So inflation and the economy, obviously. We wrote this in early April. I mean, that was before this slew of results in the last 4 weeks, which have across businesses have had the same message, the Target and Walmart messages of yesterday and today. So we say wide range of feasible outcomes, minimal change to our game plan. What's that mean? That means that we don't know what's going to happen. I have an inclination that so far it's been wrong, but I still have it, which is I think that this interest rate thing is going to end up getting rolled over before long because of either recession or transitional pressures finally unwinding as things normalize. No, it could be right, it could be wrong. We could be in for stagflation. We don't know. But there's not going to be much change to our game plan. Okay, this reminds me of 20 years ago, just like so spot on. We're getting really great opportunities in high quality growth businesses when people are just selling them. So we want to stay true to that high quality growth orientation and look through. We don't know whether we have to look through 2 quarters or 4 quarters. I don't think anybody knows. But that's what we're going to be doing. Rising geopolitical risks. China's different, in my view, post-Russia. I'm very disappointed in that because I really thought that a significant overweight in Chinese securities coming into this year was going to be a good thing. We saw underperformance last year. China's cutting. It doesn't have an inflation problem. It's going to be stimulating. The U.S. and Europe are going to be obviously raising, and it's just we have no shortage of quality growth businesses there. I really thought that this was going to be a very additive idea to be significantly overweight some high quality growth businesses in China with valuation and macroeconomic diversification from the U.S. and the West, but Western Europe. You know what? The Ukraine thing seems like all bets are off with the aggressive use of sanctions. Well, I don't want to spend a lot of time on that unless you want to talk about it. But what it tells me is with this clearly heightened tension structurally between China and the U.S., if the U.S. administration decides China's not helping quote unquote, are hurting in Russia. I don't know what's going to happen sanctions wise. We've seen it. It can be very devastating. We want to just reduce risk there. We're taking the China way down because of that. So I think geopolitical risks and then changing globalization. This is probably the thing I'm most excited about. And that gets us on industrials and industrial technology. As companies and boardrooms, this is so fascinating. They all need to rethink, how are they supplying their factories? And the cool thing is, if you talk to industrial, modern technology has been catching up, believe it or not, with industrials. So they can start applying artificial intelligence. They can start applying, industry scale digitization years after other environments. But they really are investing in reimagining the manufacturing process of businesses. And now on top of that, they need to reimagine how those businesses are supplied and where those businesses are located. And there's no shortage of really interesting industrial technology companies and industrials that have the capability to help businesses make those decisions and implement those strategies. And those companies that can do that, we believe, and those managements believe, are going to see improving revenue growth rates, improving profitability as they bring more software and more services and more recurring revenue into what was primarily more of a hardware-oriented revenue mix. And that's a really exciting element there. No stocks are getting hammered here now, along with everything else. And so I think we've got some really interesting opportunities about presenting themselves to us. Let's keep going. Okay, let's go with the portfolio positioning. Look, this is what we look like. We've got, remember, I don't know if I went through it kind of fast, but it was 25% max on any one industry group, right? So healthcare is 24.4. So we're kind of maxed out healthcare. Healthcare for us, I'm going to call it target rich opportunity set. It's got this fantastic combination of kind of defensive growth, recurring revenue businesses that, like Vertex Pharmaceuticals is one. There's many dominant monopoly position essentially in cystic fibrosis treatments, and then moving into next generation pipeline and all sorts of other areas, or intuitive surgical, right? Or near monopoly in robotic surgery, which is next generation surgery. Is better economics for hospitals, better outcomes for patients. It's benefiting from all the med tech revolution that's happening. So we like healthcare because we get this combination of defensive growth, demographic trends, secular trends, and then also some of the same med tech trends that drive technology, benefit from all the advances in artificial intelligence and semis and so forth. So it's a really cool mix. And so we're close to our risk control maximum there, and it's double weight. So that's our largest, what's called active weight or overweight in the portfolio. Technology is next, but we're never going to have a huge overweight in tech, okay? Because our diversification requirements say, look, max 25, market's already at 21.5. We're not going to have a big overweight there. Financials, typically an underweight for us. They got very cheap. So we bought a bunch when they got very cheap. So we're the market weight. We go to consumer discretionary underweight. You can see the rest. On a geographic basis, US is pretty close to the max, what we can do. And you see, let's see, let's see, you got emerging markets. I don't see it broken out. Emerging markets is about a double weight. Let's take a look at some of the holdings. These are the top 20 holdings, and some of these names are familiar to you. I'm sure many of them are. Some of them may not be. I don't know, and we can talk about those. But I can tell you, when I look at those top 20 names, I am excited. These businesses, these are buy and forget businesses, and they're getting hammered along with everything else. And I look at these businesses and I say, I want to be an owner. In fact, I am an owner, but along with you, I want to be an owner in these businesses and let them compound long term. These are high quality growth winners in the world, and it doesn't matter if there's inflation is longer or shorter. They'll win. They're going to win long term. Then maybe they're winning in terms of share prices. Happens a couple of quarters earlier. If inflation's a little less, it happens a couple of quarters later. If inflation's a little more. But these are structural winners, and I'm happy to go through any of them if you have questions. But I'm conscious that I've been talking a long time, so maybe we can have me stop talking now, and you talk maybe, or if you have questions.
Thanks, Peter. I'll speak for the cohort in my best Australian accent, which I won't do because it's terrible. Great energy as always. Really appreciate the conversation. We have a lot of questions, which I'm going to try and distill into a few different topics. One of those was on healthcare. I feel like you've covered that off. The question was if you're still bullish on healthcare. Was there anything else you maybe wanted to cover on?
Yeah, that's a great question because look, this happened in 2003. It happened in 2012, 13, and in 2012, 2013, it's happening now. The lowest growth, highest quality healthcare outperforms in periods like this. Okay, so we don't do that well in healthcare when the market really takes a hit. It's because everybody goes safe haven to the large cap, low growth names, and we typically don't own those names. They don't have enough growth. So we see healthcare right now as really interesting for all the regular reasons, and then the names we like best are getting hit. To me, it doesn't make a whole lot of sense, but it doesn't have to. The market's hitting them, so we'll be rebalancing within healthcare. But yes, the answer is yes. We do like it. We're not in the game of government regulation of pricing. Okay, there's a lot of questions about that. We don't do that. That's not where we are. So the answer is yes, but we're getting beat up a bit because we have, by and large, some faster growing. I'm going to call them, excuse the French, sexier healthcare companies than the slow growth, gigantic, ones that are outperforming now. It's close to saying the cash equivalents as you can get. So anyway.
Yeah.
What's next?
So, nice segue into the next one. Actually, you mentioned government regulation there. There's a question on China. So that's come up a bit. We know we've got some positions in the portfolio with the macro and governance environment there. Are you still seeing China as an opportunity, or is there question marks around that in the portfolio?
It's so bloody frustrating. I wish I could say yes and say, look, we're triple weight. Look, China's what, 4% of the global index? I think it's 18% of global GDP. Now, of course, okay, it makes a big difference. I know that there's not a lot of correlation between size of an economy and the size of the stock market for lots of reasons. But look, China's 18% of the global GDP and it's 4% of the global market. There's a lot of high quality businesses there, as I said. And we like the fact that the government's been roughing them up. There's all these crazy regulatory stuff that's been happening. COVID shutdown. Normally, I'd say, look, this is great. We should be double, triple weight or something in these types of businesses and that kind of draconian negativity environment. The reason I have to qualify that is the risk management thing is really unclear to me. If the Biden administration and the EU decide that China has been helping Russia or is not sufficiently cooperative, I mean, NATO and the US, I'm sure you've noticed, they're all in on this Ukraine thing. It's pretty frightening, actually, if you think about it. If against Russia on the other side, nobody knows how Russia's going to react if they really are losing face, and then China comes in and maybe helps them, given the high-profile bromance between Xi and Putin that we all saw. And what happens then with the sanctions, and what happens then with it's really hard. And so, no, I mean, my heart says this is a great time to be going more into China. My head says, man, the risk control stuff is just can't think it through right now. So
yeah. And then I suppose on that, we've got because you mentioned emerging markets where we didn't actually have a geographical weighting in the portfolio. So just where are you seeing an interest in emerging markets? And I suppose the follow-on question from that is around the conflict in Russia and the Ukraine and whether we have exposure there or how you're thinking about that.
Yeah, there's no exposure. There's no directory. No, listen, everybody's got exposure, it turns out, to Ukraine. Yeah. Because look what's happening in inflation and food and energy, right? A lot of the energy problem and the food accelerated problem management and even some of the supply chain, believe it or not. But most of that's China, the zero COVID, but it's Ukraine. So everybody's got exposure, it turns out, to the Ukraine and Russia through the inflationary spiral that we've seen. That Target and Walmart have exposure at the margin. So, but no, we don't have any direct exposure. But what that's going to do to European GDP and animal spirits, we don't know. And we're waiting to see if that tension in the Ukraine pulls back expenditures from companies. You know how you can get self-reinforcing slowdowns with people just decide, hey, we're all going to pause at the same time. There wouldn't have been a slowdown, but everybody got afraid of something and they all paused. Yeah. And you get a slowdown. And we're seeing indications from company after company that European activity is slowing down. And so we don't have any direct exposure there, but everybody's got some exposure, it turns out, in the ripple effect. I think that if you think about emerging markets, Indonesia, stands out as particularly attractive. Indonesia is an a commodity exporter. It runs its macro affairs very, very well. There's Bank Central Asia is one of demonstrably the highest quality banks in the world. It's got the lowest cost of funds in Indonesia, and they can lend out at a far higher rate than their cost of deposits. Rates are rising. The economy's in strong shape. It's diversifiable. If you look at correlations, our Indonesia exposure is uncorrelated with the rest of the market. So I like what's happening in Indonesia. I like what's happening in India. India's been sold off because of its Russia ties, which the U.S., I don't know if you saw it, the U.S. is trying to pull India away from Russia by giving them $500 million to buy arms, right? So that they don't have to buy from Russia. But also because of oil importing, right? They got the oil reliance, oil prices goes up. So HDFC Bank, I'm sure you've heard of it, but it's along with Bank Central Asia, the other like demonstrably highest quality financial out there. And so we can accumulate that on weakness as well, leading digital franchises, leading low cost deposits, all that with underpenetrated financial services, a la the EM thesis that you know about. So I personally think that we're seeing opportunities there. And I think with Brazil and Latin America, across all of the e-commerce markets, all of the fintech markets, all of the logistics markets, which are modernizing, something like Mercado Libre, I hit recently, but the business is doing extremely well, and it gives you a structural exposure to the rise of digitization, e-commerce, digitization of payments, and all of that kind of parallel economy. If you think about what's happening, you have the old line economy and then the parallel digital, economy, and that business is a toll taker all across Latin America. I'm building an e-commerce payments logistics franchise, which is bringing millions of female entrepreneurs into the economy, small businesses, large businesses. And so I think it's building a toll-taking recurring revenue mechanism of great long-term value. That's on sale right now. So that's what I like in Latin America, personally.
Great to hear that. We have a question, quite a few questions, which I'm going to get to in 1 second, but before I do, I just want to remind people that if you look at our APIR code on the fund, you'll actually see a performance track record when you go beyond May 2021 previously that predates when Harding Loevner took over the fund. And so the performance numbers would actually look a lot better. If it was
the numbers are terrible right now.
But it's actually a question for if people looked up the performance numbers and used the code, it's actually different to what you've delivered. But the question is so we people seem to understand the short-term performance, but I think where we've spoken to people about quality growth, particularly quality style businesses outperforming when you see those moderate to falling markets, when are you expecting a turnaround? What do you think has led those quality businesses down to underperform so drastically? And I suppose to round that out, when are you expecting to see it turn around, or what needs to happen for quality to do that much better in this type of environment?
There's quality and there's quality growth. Okay, high quality has been underperforming year to date, but only by, I have to go back to look at the numbers, but maybe by 6 percentage points, 6 or 7.
Yeah.
Growth was 1,200 points, 12 percentage points, and more expensive stocks close to 14 percentage points. Those numbers are a little bit out of date now but that's roughly. So If you think about high quality, it's been getting hit, but a third to half as much as growth and more expensive valuations associated with that growth. So that's there's times in the market, 02, 03 was 03, 04 was one where high quality just stops performing, and when you get a rush into short duration cash flows, inexpensive stocks, and this idea that there's going to be rising rates potentially significantly, you almost always see low quality businesses outperform high quality during that period. Our problem was we came into this thing with too much growth. The quality has not been the issue. It's been the faster growth has been the issue. Growth has been hammered. And that's our problem here in these last 4.5 months. We've had too much growth. I don't know when it's going to turn, but you can go through scenarios, right? You can think about it. You can say, well, what could happen? And you can go through the likely scenarios. Stagflation. You could have very high rates of inflation, high rates of interest, and a significant recession. If that's the case, you should probably sell quality growth, even though it's been underperforming back. If you try to time things. If you knew that was going to happen, you probably want to be in cash, or you want to be in the shortest duration cash flows you can find. and you want to be cheap, and you want to get out of the way. Now, if you think that's going to happen, frankly, I wouldn't own this portfolio, because it's probably going to get worse before it gets better, if you think you can time it and if you think that's going to happen. So that's one scenario. I don't know what the odds of that are happening, but it's not zero. It's possible. There are two other scenarios I think are more likely. One is we begin to see the economy slow down, and we begin to see all of these unusual situations, the costs from begin to normalize, and you see interest rates begin to peak, and you see inflation anniversary and roll over. And then you see a gradual shift in that environment where you have falling cost of capital, falling inflation, and you've got this valuation shift that's already taking place. I think quality growth has a very good, if moderately, I think quality growth begins to outperform again. I don't know if it's dramatic or not, but if you get the other scenario where you get the so-called soft landing, and all of this, all the anniversary of these high inflation rates roll and interest rates, and you get, some of these cost pressures in commodity, energy, and food begin to normalize. Because if you think about why they're not as shocks to the system that can normalize, you can see a very sharp rebound in quality growth. And that's where we're going to remain in quality growth across all three of those potential scenarios or others. So I don't know when they're going to happen.
Yeah.
But if you really think there's going to be a really brutal stagflation thing, and you think you can time that, I wouldn't own the quality growth portfolio.
Yeah. Okay. Two more questions. One, which is actually probably for me, there's a couple of questions around dividends in the listed investment company, and also just the profit reserve figure that we mentioned. So we have the ability to pay dividends in the listed investment company even if we don't make any money in that for the next 2 years, fully franked for the next 2 years. Profit reserve in a listed investment company is not cash. Profit reserve is just an accounting measure that we mention in our annual reports. The portfolio in the listed investment company is pretty much fully invested in line with the underlying strategy. So it's not like you're sitting in 1/3 cash in that company by any means. It's fully invested, but we have the ability to pay those dividends for the next 2 years, and that will continue all fully franked. So the last question for you, Peter, hopefully ending this on a good note. So you said you are a kid in a candy store. What sectors are looking particularly attractive for that kid?
Kid in the candy store. Not financials, not consumer staples, not energy, not utilities. It's consumer discretionary. Look, I think online models are not dead. I think the best branded retailers that have the strongest consumer engagements and brand identities globally are going to thrive and have pricing power. I think industrial technology and industrial companies that are delivering returns and efficiencies and allowing businesses to do things they never could do before are going to be very strong investors. So I would say industrials, technology, consumer discretionary, communication services, and those are the areas. And this idea that e-commerce is X growth now because it went up, sales went up 70% 2 years ago and only went up 2% year on year after that. All of a sudden, they think it's slowing down as X growth. But when it went up 72%, but it was 70 and then 2, I think it's crazy. But that's the kind of stuff that the market is pricing at the moment. So I think we have to be. We're not going to try to buy everything at once, because we have to be cognizant that this market could stay like this. But those are the areas. I see some opportunities in Japan, but not that many. I see mostly Europe and mostly US. I'm a little gun shy on the China thing for the reasons I talked about.
Great. Peter, so good to hear from you today. Thanks so much for taking the time out of your day to speak to us and our clients. A reminder that this webinar is recorded. It will be up on our website a little later today. So if you've had friends or colleagues that have missed it, please head to pengana.com whenever you feel like it. And this webinar, plus all of the insights that we have from the Harding Loevner team, are available to see. As always, if there's questions or you'd like to find out more, please go to pengana.com or contact me or any of the distribution team. Always really excited and happy to have a chat. We had the Harding Loevner team on ground here in Australia last week. It was really well received across all of the investors that we met. And we're really looking forward to the next visit and continuing these webinars. So from me, thank you very much for joining us. And from Peter, thank you for joining us too, and speak to you very soon.
Thanks, everybody.